Michael Burry, known for his prophetic prediction of the 2008 financial crash, and for his story being told in the movie The Big Short, has made his next big prediction. You see, he's bought millions of dollars of put options against the Nasdaq and the S&P 500, whilst liquidating shares held in regional banks. Or in other words, he's betting on a crash, and if he's right, they can net him over $1.5 billion. Other big names like Warren Buffett have also gotten involved, as he sold over $8 billion worth of stocks last quarter, seemingly in preparation for a massive drop. By stockpiling tons of cash, he's trying to insulate himself against the coming storm. With both the S&P 500 and the Nasdaq at historic highs, what do they know that we don't?
Michael Burry, the investor who became famous for predicting the massive 2008 housing market collapse in the US, appears to have recently placed a big bet against the US stock market.
Well, first, let's get into the details of what's actually going on here. Despite what some media outlets and people on social media have been saying, Michael Burry hasn't bet over 90% of his portfolio on this deal. The $1.6 billion value that you see getting thrown around the news right now is about how much the deal could be worth at its maximum value. But it's still a ginormous bet. Burry gained his reputation by predicting crashes. His successful short on the housing market made him and his investors over $800 million, at a time when others were losing everything. Since then though, he's made numerous Twitter posts announcing and then taking back his statements on an apocalyptic market crash. But looking past this, he's clearly still got it. By making the same trades as his company, you would have made a 56% return over the past 3 years. That's more than 4 times the 12% returns from the S&P 500 in the same period. This time, he's betting against the exchange-traded funds. These products, the bread and butter of companies like BlackRock and Vanguard, track large parts of the economy. People use them to invest in the top 500 or the top 2,500 companies, which are called the S&P 500 and the Nasdaq. If on average these companies get richer, then so do you as well. In recent years, this way of betting on the overall economy has become incredibly popular. It's seemingly a low-risk way of passively making money. With a few terrible exceptions, the economy generally goes up and it's easy to turn the investment back into cash. What Michael Burry is betting against is exchange-traded funds. And so to keep it short, the exchange-traded funds that Michael Burry is betting against are known as ETFs, which offer people the ability to spread their investment across several different companies, while maintaining the convenience of having their investment in one place. And this gives you all the benefits of portfolio diversification without burdening you with the headache of having to individually track separate investments. The amount of money people have invested in these funds has grown by around 15% every year since 2010, and they're just one of the reasons that Burry and Buffett, along with many other insiders, are seeing a coming collapse today.
That the US is on the brink of a recession, the debt default could trigger the dollar's collapse, and everything bubble is bursting while the S&P 500 could nosedive 50%.
The 10-year is reflecting the fact that a recession is coming.
Highs, lows, soaring spirits, and gut punches. The stock market's volatility has been a good reminder of why we diversify our portfolios. New data from UBS shows private assets like fine art can be especially valuable when looking for low correlation, as they have historically moved independent of stocks. Bloomberg reports, as equities cratered last year, art prices increased, along with the highest total sales ever for major auction houses. Now, the art market has actually passed its pre-pandemic level. But how can we take advantage? Well, tens of thousands of everyday investors already use today's sponsor Masterworks, where you can invest without needing millions or an art degree. We don't invest yet ourselves, but every painting Masterworks has sold to date has delivered a positive return to their investors, including net annualized returns of 10, 17, and even 35% all this year. Naturally, past performance isn't a guarantee of future returns, and any investing involves risk, including loss of principal. However, Masterworks' 15th exit as a Silly Brown piece was just a couple of weeks ago, for an annualized net return of 77.3%. And now our viewers get special access to skip the waitlist. Just go to masterworks.art/moon and see important disclosures at masterworks.com/CD. That's masterworks.art/moon. Even if ETFs were perfect vehicles to track the overall economy, there's still a lot of risk involved. At the most basic level, it means there's lots more money wagered on the stock market trending upwards. In a major crash, these products will lose value just like the rest of them. But today there's a much larger problem with them. The two ETFs that Burry is shorting track indexes which are dominated by top-heavy tech companies. And his bet against the Nasdaq 100, for example, is a bet against the 100 largest tech companies. But the top 6 companies on the list, Apple, Alphabet, who own Google, Microsoft, Amazon, Tesla, and Nvidia, are worth more than the other 94 combined. The S&P 500, which Burry has also bet against, is in imminent danger. China's economy is deflating and looks unsteady. The return of student loans will mean far less consumer spending by young people, and the banks have put hard limits on the amount of money they're loaning today. And with inflation and rising costs across the West, and we're going to see far more people default on their loans as they can't secure a bailout. And then boosted by predictions that AI and other technologies will dominate the future, and the values of these companies have soared recently in response. Nvidia in particular has skyrocketed by over 200% since the start of the year, so you can't blame Burry for seeing a bubble. Nvidia's chips are integral for AI technology, and they're set to take over the market, but if it doesn't pan out, then they're insanely overvalued right now. Rising interest rates could be a grave warning for the tech industry. AI companies in particular are heavily reliant on venture capital and investments to stay afloat. It's only once they build their billion-dollar AI models that they ever start to return a profit. With high interest rates, the massive loans they need to stay afloat get more expensive, making them harder to get. And so on a broader scale, this goes 2 ways. If the AI revolution doesn't pan out, the Nasdaq 100 and tech companies in general will get hit very, very hard. Even a slower adoption of AI technology than expected could really hurt tech companies. They're betting on AI getting big and fast. Billions in venture capital is tied up in these predictions. So if it doesn't pan out, you'll have a lot of unprofitable companies competing for a dwindling pool of investment. And this process is exactly what caused the dot-com bubble in the late 1990s. Which was based on similar circumstances surrounding the internet, instead of AI. It didn't matter that they were eventually right about how important the internet would be. The tech companies overextended themselves and paid a heavy price for it. But even if the AI revolution does keep up with people's wildest expectations, it doesn't mean that tech companies and the economy's future is secure. For these crazy overvaluations to be correct, AI will need to have a massive influence on the future of the economy. This means it's going to need to replace jobs and put millions of Americans out of work. And with millions of people losing their income, you can be sure of a big recession, as consumer spending drops like a stone and economic growth stagnates. And this is when we're going to need a massive societal shift to deal with all of this, and that will take years. And the awkward period in between, where people are forced out of their jobs, could hugely tank the stock market for years. These levels of job loss won't be limited to traditional sectors either. Some of the jobs that are most under threat right now are the coding and software engineering jobs that make up the AI industry itself. Some jobs like UI design, management, and other jobs that all need a human touch will last for decades, of course. But AI is perfectly capable of replacing other jobs like data analysis and general programming. The process is most likely to help the largest AI firms, who already have their foot in the door. Using their more advanced AI, they'll have the means to replace the most employees and become the most efficient companies. Monetization of AI has so far only been successfully done through subscription services. But people and companies aren't going to want tons of different subscriptions to different AI companies. Whichever one that can offer the most services will succeed. Similar to today with streaming services, too many of them will spread the market thin and impact everyone's profits. And with how things are progressing, companies at the top like Microsoft, Meta, and Google will be in the position to establish yet another monopoly. In the next recession, they'll be able to weather the storm while smaller AI companies and startups fall apart. It'll make the industry even more top-heavy, magnifying the issues with index funds, the Nasdaq 100, and the overall economy. And as we've seen, there's tons of vulnerabilities within the current system. We haven't even touched on the housing market yet, but it's in shambles. The experience for young people and first-time buyers is brutal. First, and probably most importantly, house prices have severely outpaced wages, and you can see it by comparing the median household income to house prices. Even at the top of the housing bubble in 2006, they had risen to 7 times the average income. Today, it's even higher, nearing 8 times the average income. In New York, for example, it's 10 times the median household income, and in Los Angeles, it's a staggering 13 times, despite higher pay. Meanwhile, high interest rates have made the actual mortgage rates far more expensive. But just like the housing crisis of 2008, a massive part of the problem is due to corporate greed and single-family housing being used as a vehicle for massive investments.
Okay, the consumer's strangled. They're watching their housing prices go lower, they're watching their 401ks get diminished, they're spending higher prices on everything in their lives. So we're in a bad environment, and typically in environments like this, markets need to end in a dramatic way, I'm sorry to say.
In Charlotte and Atlanta, at the end of 2021, investors bought over 30% of the homes up for sale. I'm talking about companies like BlackRock and Vanguard buying up all of the homes of America.
Question that investors are making big buys in residential real estate. Numbers from last year show they were behind 18% of all home sales nationwide. And here in Charlotte, 32% of all home sales went to an investor.
Because nationwide, they bought over 18% of homes, nearly 50% more than the 12.4% they bought the year before that. And the majority of these houses are small, family homes, often in underdeveloped and poorer neighborhoods. And at the pace we're going, over 40% of all single-family homes could be owned by corporations in 2030. Families trying to buy homes in these areas will often find themselves having to make offers tens of thousands of dollars above the asking price, only to find out that they've been outbid by some conglomerate across the country far away. From there, the corporations doing this, like the Invitation Homes and Tricom Residential, have used massive funding boosts from finance companies to outbid the little guy. Then they turn it into rental properties, keeping millions of families in the rental trap and out of reach of homeownership. These corporate landlords are far worse than the local ones, both for the tenants and the economy as a whole. They're more likely to hike rent prices, ignore essential repairs and evict tenants, and all of this money just goes straight back into the scheme to buy more family homes or to the Wall Street vendors funding this whole operation. All of this money then goes straight back to the Wall Street investors funding this whole operation. This can't go on forever. Soon, something will reach its breaking point, and the economy will very soon slip back into a recession. At least this is what Michael Burry and Warren Buffett think. The bottom line here is that we are heading into a transitional period in history. The global power structure is shifting, and with the Ukraine war showing no signs of stopping, the world has been plunged into conflict. And with China and Taiwan on the brink of a war, global tensions at an all-time high, makes it insane to think that the current upturn in the stock market will weather the fundamental societal shifts that are about to happen. Michael Burry's been wrong before, and there's no reason to base your decisions over what one person is doing. But you can't deny that there's a storm on the horizon. The current system is far too hostile for the vast majority of people, and as more young people check out of the grind and a large proportion of society enters retirement, we're going to struggle to keep up with the growth the economy needs to stay afloat.